Hey everyone, welcome back to Yuri's Box. In this video, I'm going to look at TLT, the week ahead, as well as today's data. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So really, this video is going to be a a mashup of sorts. It's going to be a mix between the weekly close video for TLT and the week ahead. And the reason why is I'll be out of town for the next couple of days, so I won't be able to go over some of the data we get today and, really be able to make videos. So it'll be kind of compressed all together. And the best place to start, in my opinion, is something I haven't spoken a while. I haven't spoke about in a while, rather. And that is the GDP Now model of the Atlanta Fed. The last time I spoke about it, if you recall, I was expecting this to really have a significant jump back up, for the simple reason that the reason why we saw this dramatic fall in the estimate for the Q1 GDP is because what goes into GDP is net exports. Okay, so if you have exports being higher than in the imports, that'll be a boost to GDP. If you have imports being larger than being greater than the exports, then that'll be a drag on GDP. Right? And given the fact that we had a lot of tariff front running on, so a lot of imports, I was expecting some sort of adjustment, to this estimate. And again, I was quite early because the moment it dropped, I was expecting it to jump back up around, back up the week after. But it's Friday 28th, and recently the Atlanta Fed came out with an updated model, which adjusts for some of the gold imports that occurred in Q1. And accounting for the gold imports, the estimate for Q1 GDP is somewhere between, a little over zero. So yeah, here it is, 0.2%. At the end of the day, I think that the real number for GDP in Q1 will be closer to somewhere between 0.5 and 1.5, somewhere in that range. Something like that. Now, I could be wrong, but I'm still not expecting this to print as low as it is. But we'll see. Again, I wouldn't be shocked if it actually comes in at 0.2, 0.5, something like that. So yeah, keep an eye out for this model, and as it will really give you an idea of what to expect on GDP for Q1. The next thing I think is worthwhile talking about is the PCE, and we're getting that number later today, in about 4 hours, something like that. And consensus puts it at 0.3%. This week, I already said that I wouldn't be surprised if we get 0.4. And I've also seen some betting markets. I saw Kalshi, if I'm not mistaken, pointing towards the possibility of a 0.4 print on PCE. And the reason why is, if you recall, in where was it? I think it was right around here. Some of the components that made up PPI, right, when it got released. So PPI was cooler, but some of the components that go into PPI were somewhat hotter, and that led the bond market to really price in the potential for a hotter read on PCE. So could we get a negative surprise on PCE? Absolutely. If we were to get a 0.4 print on PCE today, I wouldn't be surprised if we actually, now when the pre-market we're rallying really, but I wouldn't be surprised if PCE actually acts as a negative catalyst, at least in the short term. And again, it could be, another clue towards, the possible retest that I've been really been talking about since the beginning of the month, even while we were at 92.50. And again, if we get 0.4, that could be, further fuel. However, if we get something like 0.3 or even a 0.2 print, like Trading Economics is forecasting, I don't have to tell you what to expect. I think even if we get 0.3, it's just, the coast is clear, and, possibly we could regain the bull market support band, but, I'm not too bothered with short-term fluctuations, and as I say many times in my videos. But in any case, keep an eye out for PCE, as it'll definitely be a catalyst, at least in the short term. Something that kind of connects this week with next week is the initial jobless claims, and I think that is a good spot to go to. And this week we got a print of 224. Basically coming in line at expectations. Expectations were for 225 on initial jobless claims yesterday. And honestly, it didn't really surprise me. Now, we do have another print for the month coming out next week, and we still don't have a forecast for it. I would keep an eye on it for next week, really, because, again, when initial jobless claims are really kind of the bellwether for where unemployment rate will go. Now, I'll touch on what I'm expecting on the unemployment rate a little later on in the video. But basically, the idea is that, and this is just my personal way of interpreting things, I could easily be wrong, as I said many times, but anything between the 215 to 220, anything that prints between 215 and 220 on the initial jobless claims, you can generally expect the unemployment rate to be unchanged. Anything below 215, you can expect the unemployment rate to move significantly lower. Anything above 220, you can generally expect the unemployment rate to come above, the previous print. So put in an increase. Something like we saw really last month. We started off at 214, we went 220, then we had 240, 242, then we had 222. And that actually led me to believe, given the fact that we actually had a spike and, we sustained over 220, that kind of gave me the indication that we could have seen an increase in initial jobless claims. And, my estimate last time was for 4.1. I remember my forecast for the non-farm payroll report was 105 on the jobs added, and 4.1 on the unemployment rate. I got the unemployment rate. I was a bit too pessimistic on the non-farm payroll report, but in any case, I'll touch on that later. Keep an eye on the initial jobless claims, as really, if we get something above 220, all right, say that next week's number comes in at 230, anything between 230 and 240, you can generally expect or make the case for a higher unemployment rate next in the next report, so something like 4.2%. If you see anything below 220, if you just see a dip below 220 or anything between, I would say 220 to 210, expect it to be more of the same, in my opinion. The lowest we could go, I think, is 215, honestly. But again, initial jobless claims have a history of surprising to the downside in this cycle. So, anything is possible. So again, keep an eye on initial jobless claims next week, as it'll give you an extra clue, to what to expect on the unemployment rate side of the report and next week. Following, we have JOLTs report coming out on Tuesday, 1st of April, if I'm not mistaken. Yeah. Now, I'm not a real fan of the headline number, the job openings. For the simple reason that, the only real insight that this number can give you is on the direction, right? Is the economy expanding? Are they, businesses looking for more jobs, and are more jobs available? Or are we on, the other side of of the mountain? Are we decreasing? And job openings again decreasing, and you basically don't have businesses expanding. That's the way you can interpret it. And the reason why I have these arrows here, or my best attempt at an arrow really, is because every time we see some kind of a bounce in the headline numbers of the job openings, you tend to see a lot of articles touting the strength of the economy. So from here to here, it's the economy is great, it's strong. Then we keep falling, then it bounces. The economy is so strong, man, and then we keep dipping. And even here, I remember, or even like this year is a great example right here. We were on the uptrend. Potentially, we could still see a rise on the job openings, right? But here and here, I remember the articles. There's pouring in. The economy is great. But then we just resume the previous trend, and that's how things have been going. But in any case, I don't really pay that much attention to the job openings. I don't think it's that consequential. What is consequential in the JOLTS report, in my opinion, is the quits rate. All right, and why is the quits rate so important to me? And I've explained this in my videos, but I'll go over it again. Whenever you see the quits rate at cycle highs, that is an indication that labor market participants are seeing abundance in the economy. And the fact that they see abundance, mainly with jobs they can switch to, gives them the leverage to go to their current employer and ask for a raise. And so this is something that actually drives up wages. If you see the quits rate at cycle highs, you're likely to see wages increase. All right. If on the other hand you're at the other side of the spectrum, right, when the quits rate is cycle lows, that is typically referred to as an employer's jobs market or labor market. For the reason that if people aren't quitting, it's voluntarily, is because they don't see the abundance that they saw back here. They don't see jobs they can switch to, and so they're not confident they can find another job if they quit their current job. And so that really takes away the leverage from the employee, and it gives it back to the employer. And that is what's the consequence of that? The consequence is that wages are more likely to stay flat, right? You're no longer going to see these huge wage gains that you saw on when the quits rate was rising, all right, up until really February, or even when it was still at elevated levels here. So that is why I would pay attention to the quits rate. I usually think about the quits rate as, the direct competition to something like the University of Michigan survey, and something like Conference Board Consumer Confidence Index, for the simple reason that something like the quits rate does not keep in mind, people's opinion, because again, it's just looking at what people are doing. It's not a matter of what people are thinking, or whether they're Republican or Democrat or whatever. It just looks at what people are doing, and when actions speak louder than words. On the other hand, if you have something like the University of Michigan, which actually we're going to get another print today, if I'm not mistaken. Yes, we're going to get another print today. Again, I want to try my best and actually cover this survey better, even though I'm not a fan, and I made that pretty clear. But again, the problem with these surveys is that you get signal, all right, because say, we are back effectively at 2022 levels. We're way below the pandemic. And actually, the preliminary print was actually here the previous number was 57.9. We're expecting a 57.9, being confirmed here. So keep an eye on that. But in any case, who do I listen more to, the quits rate or Michigan University Consumer Survey? All day, the quits rate. Who do I prefer between the Conference Board and the quits rate? The quits rate all day, because I don't have to account for people's political bias. All right. So again, if you have to really pay attention, if you want to pay attention to the JOLTs report get released on Tuesday, look for the quits rate. Second, look at the hiring rate. And third, if you have some spare time, look at the job openings. While we're at it, we're actually going to get the ISM PMIs. Now, the ISM PMIs are really, the way you have to think about them, it's the kind of on the same vibe of what the S&P reports are doing, like something like that. I pointed out. Let me see if I can find it right here. You're gonna get something like this. All right. This is basically what the ISM does. Now, the only caveat is that the ISM has a history of being slightly more pessimistic than the S&P PMI. Like, if you look at July of 2024, ISM was already well below 47, 46.9 up until October. Again, it kind of has a history of being a bit more, crying wolf. All right. Keep that in mind. You could see a bit more of a negative tilt to things compared to the S&P reports. This is actually something that I remember moved markets quite a bit last summer. We started getting employment rate moving higher. And we got the miss on the non-farm payroll report. And I remember that during that time we had something like the ISM reports add fuel to the fire, and actually really the bond market kind of went along with it. And but overall, the S&P reports tend to be a little bit more accurate, meaning that they just don't have that extra negativity aside on their side. So do keep an eye on the ISM PMIs, as it will definitely give you an extra piece to the puzzle. And now, while we're at it, the reason why I like to look at these kind of reports is that it kind of gives you, again, it tells you what to expect on the following non-farm payroll report. If you see these reports pointing towards business expectations for the year ahead fell the lowest since October 2022. If you saw something like this report says, activity growth picked up in March, but just what is the general vibe that is coming out of these reports, and you can use it as basically a way to temper your expectations for the following non-farm payroll report. Okay, for the jobs added side of things. All right, if you read that businesses, are optimistic and everything's looking great, new orders are flowing in, and again, business expectations for the year ahead are sky high, you can generally expect a good non-farm payroll report number. If you see, on the other hand, something, something opposite, something like we saw in February and we kind of keep on seeing, and, as I read in the report, you can generally expect a miss. Now, while we're on the topic, as I said before, my forecast for last month was 105 on the non-farm payroll print and 4.1 on the unemployment rate. And again, the reason why I was expecting that is because reading the reports, there was quite a lot of negativity in the put in those reports that businesses were reporting, and so I was expecting a miss because of that. Now we didn't get that big of a miss. Basically came in at expectations. We got 150, something like that, on the jobs added, but I got the unemployment rate right. Now I personally won't give a forecast this time because I generally don't know what to expect. I mean, we went over the all these reports, and while on one side they continue to point towards really a confirmation of what we saw in February, they point to activity picking up somewhat in the month of March. So let me see if we have a forecast. We should have a forecast by now. Too far ahead. Here we are. 128. And Trading Economics says it at 80k. I think this is a reasonable range. I'd subscribe to this range here. I would expect something between 80 and 120. That seems fair. Now, but I won't give really a precise number because I really have no idea what to expect in this number. We could, get a ridiculous 200,000 prints, given the fact that, some of the reports actually print to activity picking up somewhat. Now, that is counterbalanced by the fact that expectations for the future have dimmed quite a bit. So if your expectations for the future are turning sour, you're less likely to add people. But in any case, I think that 80 to 220, as a general range is fair. As far as the unemployment rate is concerned, now I come back to the initial jobless claims. So let me have another one here. All right, so jobless claims. We got 221, 225, and 224. That is just above my 220 range. If I had to guess, what will likely move? Now again, we're still missing one report for the month. If next week's report comes in, as I said before, 230 or 240, I would expect to see 4.2. 4.2 would be reasonable. Assuming, however, that we get something like 220, and so we're just basically flat, what could move the unemployment rate, and one way or the other, is the participation rate. So next week, I think that the participation rate will, is worth looking at when the numbers get released, simply because if you see the participation rate dropping, that could artificially, push the unemployment rate lower. And if you see the participation rate go up, that could push it higher, could push the unemployment rate higher. Now, a declining participation rate isn't necessarily good news. I mean, if people are leaving the workforce because they can't find another job and they're just quitting altogether, that it definitely isn't that definitely isn't good news. So, just because maybe the unemployment rate stays flat or even dips because of something like the participation rate going down, I wouldn't take that as good news. All right, yeah, you always have to put things in the right context. But again, on March 28th, as of today, if I had to choose what will likely move things, the initial jobless claims of next week, and adding that together with this month's initial jobless claims, or the participation rate, given the fact that we have come around, always this week at around 220, I would point to the participation rate being the culprit for any move in the unemployment rate. All right, so keep an eye on that. We also get ADP on Wednesday. Let's see if I can get the estimate for that to 60K. Well, we really don't have a consensus on that yet. Trading Economics is pointing at 60K. I really don't pay that much attention to the ADP report, as I said in last month's videos, for the simple reason that whatever we see on the ADP report, that generally doesn't translate into the non-farm payroll report. All right. For instance, last month we had an estimate, a forecast for 140. We got 77K. Right now, granted, this only keeps in mind private payrolls. However, we got 77, and what we got on the non-farm payroll was about 151. Now, again, this is counting everything, not just private payrolls. But again, this isn't really to say anything about the last report, because you have to account for the fact that the hiring freeze at the government level and everything. I'm just using it as to make the point that whatever you see on the ADP, try not to read too much into it. You really have to wait for the non-farm payroll print on Friday to actually make a good judgment on wherever the economy is standing. So that really I've said everything, I think. Really that's one thing I wanted to talk about. We really have the added bonus of the yield curve to look for. Now, I'm not expecting anything too dramatic next week. All right, as usual, if I had the meme that of the guy that says, "Oh, nothing ever happens," I would generally subscribe to that meme, simply because we occasionally get those huge deviations that that surprise everyone, and this month could definitely be that month. But given the fact that in the PMI reports we saw some kind of contrasting rhetoric, because again, on one side the outlook has dimmed, but on the other side output is still kind of sustained. So that to me still points to the possibility of a miss, as I said, but I wouldn't bet the family farm on that. To things really just still hanging in there, and possibly maybe the the April report could perhaps reserve some surprises. But one thing that makes me kind of wonder if next week could be some kind of a surprise to markets is the yield curve. Now, as I pointed in I made a video on the yield curve. When the yield curve is a recessionary indicator, but not in the sense that a lot of people point towards. It's not a matter of time after the uninversion, all right? It's a matter of the level that it breaches. And, I highlighted the 50 basis point spread between the 10 and 2 treasury bonds and the 100 basis point spread. So like historically, whenever you see the 50 basis point spread level get breached in a sustained manner, that is an indication that something's up, right? Something is happening. It's kind of the first yellow card that you get in football or soccer if you're American. All right, it's the first warning, and if you get another yellow card, and you go over the 100 basis point spread, you get the red card and you're off. Meaning that something definitely happened. All right, if you're over the 50 basis point spread in a sustained manner, that could indicate that hey, something might be up. If you're over the 100 basis point spread, historically speaking, that tells you, yeah, something happened. Something definitely happened. And this week we saw that spread increase to the highest point, 36 basis points. And it just makes me wonder, are we just kind of, perhaps just preparing to breach that 50 basis point spread next week? Could it be that the non-farm payroll report pushes the 2-year significantly lower and everything across the board, but just having the 2-year yield perhaps retest something like the the 350 level, and that actually that would be a 30 to 40 basis point drop if say the 10-year drops. If the 2-year is dropping, say 40 basis points, you could expect the 10-year to drop something like 20 to 25 basis points. That would actually push the yield curve, well, the spread between the 10 and 2 is over the 50 basis point spread. Given where we are now, it could generally be a reason for, it could actually be, given where we are right now, the reason why we see the first time we breach the 50 basis point spread. So that is definitely one of the things that is making me wonder, could next week be the first miss on the non-farm payroll report, and that actually being the catalyst for significant uninversion. That's something that the yield curve is really one of the things that is making me really wonder, making me question, could we have a significant miss next week? Now, important thing to say is that this movement that we had right here isn't actually the positive kind of movement that you'd like to see if you're holding bonds, because what you like to see is a bull steepener. So something I was pointing to before, the 2-year drops 50 basis points and the 10-year drops 25. All right, you have the 2-year dropping faster than the long end, the short end is dropping faster than the long end. All right, and that is actually bullish for bonds. If you see, however, the long end rising more than the 2-year, that is bearish for bonds, because you still have an inversion of the yield curve, but it's not happening in a way that is positive for bonds. All right, and that's kind of what we saw this week. Yields generally drifted higher overall, so that's important to keep in mind. But again, given the fact that we have significant data coming up next week, it just makes me wonder, is the yield curve preparing for a dramatic move? I don't know. I just wanted to put it out there before it actually happened, before we get the numbers out. So you have that. You can keep that in mind when we get the numbers. I'll leave it at that. Again, I won't be making videos this weekend because I will be out of town. But again, keep an eye out for everything I pointed out in this video. If you had to choose, look at the quits rate. Keep an eye out for the ISM on Tuesday, and initial jobless claims and non-farm payroll print. That's kind of the meat of the of the news next week. And if I'll be back next week and we'll talk a little more of what to expect. But again, and keep an eye on the yield curve. Bonds seem to have reacted to something overnight, at least. But in any case, this is a developing story, as I said. Don't pay too much attention to the short term. Before I close, really, TLT is currently up in the pre-market because of yields kind of drifting lower by 2 or 3 basis points. Again, today I think could be one of the days where you get further indication of whether or not we're going to retest this trend line right here, for the simple reason that if PCE comes in at 0.4, that'll be a catalyst for further decline in TLT and yields rising. If we get 0.3 or 0.2, something like that, you can expect TLT to have an okay day. Really, it would really depend on everything else that is happening. But overall, this is something that I've pointed, really for a month. This could happen, and I wouldn't be surprised if it actually ends up happening at this point. But in any case, keep an eye on the data, which at the end of the day will really tell you where things are going. I don't really think it's time to pay attention to the technicals and the squigglies on charts, because again, if data comes in negative, well, you can expect positive movement for bonds. If it comes in positive, if the news comes in positive, well, expect bonds to suffer. We're in that kind of environment for now. I'll make more videos next week when I come back. And again, if you like this kind of content, consider leaving a like, and I'll see you next time.